7% gone, 18% vanished. The world's favorite safe haven just became a danger zone. This isn't a glitch, it's a signal. When we see drops of this magnitude, we have to look beyond the charts. Technical analysis can't explain a move this violent. We need to look at the fundamentals. Historically, gold is the ultimate safe haven. When geopolitical tension rises, investors flee to gold. So with current global instability, why is gold falling? The answer often lies in the US dollar. The dollar and gold are like ends of a seesaw. When one goes up, the other goes down. Today, the dollar is flexing its muscles. Now, let's look at silver. It dropped 18%. Why deeper than gold? Because silver is also an industrial metal. Fears of economic slowdown hurt industrial demand, hitting silver twice as hard. Traders watch the gold to silver ratio closely. It usually sits around 65. Recently, the gap widened, signaling a potential snapback. But instead of rising, the floor fell out from under silver. But the real trigger for today's crash is political. It's about who controls the money printer. Donald Trump has made his move for the Federal Reserve. Trump has nominated Kevin Warsh. The market was terrified Trump might destabilize the Fed, but Warsh is a serious, traditional choice. This calmed the chaos, boosting the dollar. So, who is Kevin Warsh? He is a former Fed governor. He is known as a hawk. He believes inflation is the enemy, not high interest rates. This creates a conflict. Trump wants zero rates to boost growth. Warsh wants stable prices. The market is betting Warsh will keep rates higher to kill inflation. Higher rates mean a stronger dollar. A stronger dollar means expensive gold for foreign buyers. That is the mechanics of today's crash. It's a repricing of the future. We've covered the crash and its political trigger. But to understand where we're going, we need to look at history. Is 2008 repeating itself? Everyone is panicking over a daily chart. But if you zoom out, history is screaming at us. Look at 2008. Before gold went to the moon, it crashed hard. In the early stages of the Great Financial Crisis, gold dropped nearly 30%. Why? It's called a liquidity crisis. When the system breaks, investors sell everything, even gold, just to raise cash. It's the margin call from hell. Hedge funds dump their winners to pay for their losers. Today's drop feels exactly like that initial liquidity squeeze. But there is a bigger signal flashing red, the yield curve. For months, it was inverted. Now, it's uninverting. Historically, this is the 100% accurate signal that a recession is imminent. When the short-term rates drop faster than long-term rates, the curve steepens. This happened before 2000, before 2008, and it's happening right now. This brings us back to Kevin Warsh. He wants to fight inflation. But what if a recession hits first? If the economy crashes, even a hawk like Warsh will be forced to pivot. And that is the moment. The moment the Fed pivots to save the system is when gold bottoms and rockets to new highs. We are likely in the flush before the pump. So we have the crash and we have the recession signal, but how do you actually protect your portfolio? There is a specific strategy for this phase of the cycle. So how do we play this? If a recession is coming, cash is king initially. But once the Fed pivots, you need to be in the assets that move the fastest. First, silver. Silver is gold on steroids. It's high beta. When gold goes up 10%, silver can go up 20% or 30%. But it crashes harder too. It's not for the faint of heart. Then there are the miners, stocks like GDX and GDXJ. These companies have operating leverage. If the price of gold rises above their production cost, their profits explode exponentially. However, miners are stocks. If the general stock market crashes due to a recession, miners often get dragged down first. You have to time the entry perfectly. And while we wait for the pivot, look at the whales, central banks, China, Russia, India. They are buying physical gold at record rates, hedging against the dollar. Follow the smart money. The signal to go all in is the pivot. When the Fed cuts rates to save the economy, that is the green light. That is when the liquidity floodgates open. But there is a new player in this cycle, one that didn't exist in 2008, Bitcoin. Is it the new gold or is it a trap? Now, we have to talk about the elephant in the room, Bitcoin. For years, gold bugs laughed at it. But in 2024, if you ignore Bitcoin, you are ignoring the fastest horse in the race. Is it digital gold or is it a tech stock? The data shows it's both. It acts like a tech stock during liquidity crunches, but it acts like gold during currency debasement. It is the ultimate hybrid. This cycle is different because of one word, ETFs. BlackRock and Fidelity have entered the chat. This legitimizes the asset class. It opens the floodgates for pension funds and sovereign wealth. And we just had the halving. The supply of new Bitcoin was cut in half right as demand from ETFs is exploding. Economics 101. Lower supply plus higher demand equals higher prices. I call Bitcoin the liquidity sponge. When the Fed pivots and prints money, that excess liquidity flows into the riskiest, scarcest assets first. Bitcoin soaks it up faster than anything else. But there is risk. Regulation. Governments hate competition for their currency. If the dollar collapses too fast, they might try to ban the exits. Bitcoin is the exit they can't easily close, but they can make it hard to use. So where does it fit? It's your call option on the collapse of the fiat system. You don't need 100% of your net worth in it. Even a 1% to 5% allocation can hedge your entire portfolio. We have gold for safety, silver for leverage, and Bitcoin for asymmetry. But how does this all end? In the final part, we look at the endgame and the death of the dollar. We've talked about gold, silver, and Bitcoin, but why do we need them? Because of a simple math problem that cannot be solved. It's called the US national debt. $35 trillion and counting. But the debt isn't the problem. The interest on the debt is. For the first time in history, the US pays more on interest than it does on its entire defense budget. This is called fiscal dominance. The Fed loses control. They cannot keep rates high because if they do, the government goes bankrupt paying the interest. They are trapped. There is only one way out. It has been used by every empire in history, from Rome to Weimar Germany. You print the money, you inflate the debt away, you pay back $35 trillion in dollars that are worth pennies. This is not a conspiracy theory, it is history. When the debt becomes mathematically unpayable, the currency dies. The pivot we are waiting for isn't just a rate cut, it's the start of the final devaluation. Your savings in the bank are melting like an ice cube. 2% inflation is a lie. Real purchasing power is vanishing. That is why you hold hard assets. So the system is breaking. The debt is unpayable. And they are about to turn on the printers forever. What is the end game? And what is your final portfolio allocation? We wrap it all up in the finale. So, how does this movie end? The dollar standard, which has ruled the world since 1971, is dying. The world is splitting into two blocks. On one side, the BRICS nations. They are accumulating commodities and gold to back a new trade currency. They are rejecting the debt-based dollar. On the other side, the West is moving towards central bank digital currencies, CBDCs, programmable money, total control. If you don't spend it, it expires. If you dissent, it freezes. The only way to opt out is to own assets that have no counterparty risk. Here is the recession-proof allocation model for this cycle. Gold, 25% to 30%. This is your insurance. It preserves wealth when the currency collapses. It is the bedrock. Silver, 10% to 15%. This is your growth engine. It outperforms gold in the late stages of the bull market. Bitcoin, 1% to 5%. This is your asymmetric bet. If it fails, you lose 1%. If it works, it can double your portfolio. And cash. Yes, cash. Keep 20% liquid. Why? To buy the blood in the streets when the liquidity crisis hits. Cash is optionality. This is not the end of the world. It is the greatest wealth transfer in history. If you are prepared, you won't just survive, you will thrive. Stay safe, stay liquid, and I'll see you on the other side.